So I'm going to shift to new fund offerings because
There
this
you
is what's coming
go.
down the pike. So
This is
yes,
exciting. What's coming down the pike,
this is fun.
Benjamin?
So we've really identified kind of three primary verticals that we're really focusing on in 2024 that we think have the best risk-adjusted opportunities for investors and for really capturing opportunity in the market. And so you've probably seen the release of our Aspen Private Credit Fund, and this is something we're super excited about. This is just honestly hit the ground running, and we've already got our first 4 assets locked in. I got a 5th one, term sheet put out today, and they're likely they're verbally accepted it. So we got a lot of amazing assets in this fund, and it's, from my perspective, one of the best ways to capture, the long-term fundamentals of multifamily are good.
Right.
We're looking from a 3 to 5 year standpoint. We need housing.
There's demand.
There's
Right.
demand.
There's a housing shortage.
There's no absolutely about that. But to go in common equity and just to have exposure to cap rate expansion, to have exposure to the other kind of risks involved right now, capital call risk, all these things. The better way to play it is going lower in the capital stack,
Private equity,
having a
mezz,
more credit focused perspective in it, but we're earning way above market yields because there's this huge gap in the market. So anyway, open-ended fund. We are really excited about it. I have another slide just to share what the structure is on the next slide here. We also alluded to it a minute ago, but Dan, do you want to share just of some of the pipeline we have for industrial? We've been working, or really we, meaning Dan, has been working pretty hard the past year, just building a pretty big pipeline,
deep and
of
sweet
opportunity
pipeline of industrial coming down the wire.
Yeah, absolutely. Thank you. Yeah, we've got a half a dozen coming down the pike, and some of these are, not just one building, but they're in actual developments where we do up to 1 million or 2 million square feet. Ben alluded to the one that we close on the land in the next 2 weeks, which is on the east side of Wichita, and the way we're looking at these is not just a distribution industrial. We're looking at kind of our thesis on, reshoring manufacturing as well. And so a lot of our projects are around whether a new chip plant is going in, whether a new industrial manufacturing plant is going in. So East Wichita is one that we can talk about. It'll be 1 million square feet in Bel Air, which is close to all the highways, close to all the airports, close to Koch Industries, hopefully close to an expansion of a chip plant. That will be 1 million square feet that we can put up in the next 3 or 4 years.
And we got IRBs on that, so already added a huge amount of value.
Right, fully incentivized and ready to go. Friendly community, they like manufacturing. And then we've got one that's pretty close to being teed up in Oklahoma City, kind of the same type of philosophy there in terms of location and end user, and that one would utilize the rail, which obviously gives you a higher lease rate. And then we've got 3 or 4 others that are in the wings we can't really talk about, but they're in Kansas City, they're in Arizona, we're even chasing some stuff down in Laredo, Texas. So a lot that we can bring online, a lot of capital we can put to work, and so we've got a nice pipeline to build on in the next, we could, 10 to 20 years if we want to stretch it that far.
And to talk for just a second about our why, we're going to tertiary markets, right? The smaller markets, which we like, and we're building while everybody else has their pencils down. So explain why all these things make sense.
Well, it makes sense because we know people are out there in the market looking for buildings. We've run across this in Wichita, is that there's just no inventory. If you go to Kansas City still has room for manufacturing plants. We just like the smaller markets, good locations. Everyone wants to be within, 1 day delivery of everywhere. So people are pulling away from the coast. They're filling in we're filling in, where we can in the smaller markets that have the best location, that are drivable, but also have a very strong manufacturing base. That's kind of what's become our niche in terms of what we're looking to develop.
And talk about the pencils down scenario where there's just not a lot of new construction.
Yeah, there's just not out there. I mean, you've got the large, we've run across this in Oklahoma City where there's a lot of land sitting there, but the large developers have decided to wait for rates to come down to start to build. And in an 18-month lag on building a 250,000 square foot building, we kind of want to be standing there with the only game in town with a finished building over the next 18 to 24 months, when everyone else is waiting to,
Right.
get their financing and start building and be behind the curve.
Yeah. So over the next 2 years, you're not going to see any supply come out on the market, basically.
right.
And so we'll be the only game in town in these tertiary markets, which are ideal for manufacturing and distribution, you know, and in the Midwest, which we love.
Right.
Yeah, because of the pipeline we built and the key relationships we have, our yield on cost on these assets is really above market. And talking with a lot of different brokers and lenders I've been talking with, and really gives a huge amount of margin. But there's still, like, I was looking at a report from Green Street, which is a huge kind of reporting firm in real estate, and industrial is really by most measures been the least impacted from a valuation standpoint of any real estate asset class. And so it continues to be the darling of the institutional money. They want industrial, they see what's coming, but there's not a lot of transactions happening. There's not a lot of new construction happening. And we feel right now is a really key time to kind of, people are zigging, let's zag with smart projects, with good partners. And, fast forward a little bit of time, we're going to be sitting really well.
And again, bringing institutional grade assets to retail investors. So a lot of retail investors are in multifamily, but a lot of them haven't gone into some of these more institutional asset classes, like industrial or like oil and gas. And so we want to bring really best in class institutional grade assets to everyday investors.
Yeah. Speaking of oil and gas, we got another fund that we're teeing up. We're expecting that to launch sometime this summer. And so really it's literally going to be
dry out your powder, guys.
Yeah. It's going to be a carbon copy of the last fund, where just continue our acquisition.
As long as the market is in this kind of buyer's mode, we're going to keep building as many funds as we can, buying as many of these assets as we can. And if I'm wrong, we're going to just be happy making, 20, 25, 30% returns. And if I'm right, it's going to be way more than that.
Yeah. So,
and that fund is with the same partner that we have in the other UEF, the other oil and gas fund. So,
Yep. Go back to the private credit fund. I'm not gonna spend a lot of time on this because we're a little over time here, but if you have interest in it, we think it's an amazing opportunity to get, current cash yields in preferred positions in commercial real estate, and it has liquidity. So it's got this, really great options for your credit part of your portfolio, where you want to get the yields, where you want to be kind of a lower risk position in investing, and really capture, in my opinion, a great risk adjusted opportunity in the marketplace right now. So we're excited.
Quarterly liquidity. So it's open-ended, which means we think this fund is going to run for 10, 20, 30 years. And you put capital in on any quarter, take money out on any quarter.
So, after 2-year lockup. So not any quarter, but close. So open-ended fund. Excited about this.
And really, really nice returns.
Yeah. And we're starting out the gate with audited financials and really taking this to an institutional level. We'll likely be working with some larger institutional partners. We already have a lot that have started giving us commitments. And we expect this fund to scale up to a pretty nice size here over the next year or so.